an urgent question is around the rising operational costs. So we want to share with you our assumptions on the global front there. And businesses have been facing these rising operational costs on many fronts for almost a year now, and we expect most of these, unfortunately, as you can see, to remain elevated in the first half of 2022. You can see the relative timelines of when we start to see some easing in these components, and quite a lot of them are unfortunately putting some pressure on businesses for the first few months, at least of next year. And very importantly for this region, as Frontier View, we have revised up our Brent crude oil forecast for an annual average price per barrel at $80. And we know that global oil inventories have been falling in recent weeks, which actually has led to a significant increase in the spot and future prices. So there is additional kind of increasing concern that OPEC Plus is unwilling or unable to increase production adequately to meet that growing projected demand, as of course more and more countries are normalizing their consumption patterns. So we have a meeting coming up for OPEC early November next week. We will see their production increase plans, but we don't expect that they should compensate for the lack that exists, the shortage that exists in the market right now. There are also, of course, additional concerns that there's going to be some more demand for crude oil to substitute for the scarce natural gas that we're experiencing, particularly in Western Europe. So there are some risks that do point to some periodic, even upside price shocks, while of course we have basically the projected supply and inventories would leave the global oil inventories well above the levels that we had seen actually in the 2010-2015 period. There's still some supply chain and transport issues that might create some short-term price spikes as well. And we'll see what this means for a lot of the countries. This is, of course, positive for many MENA markets in terms of the oil exporters, but we don't expect a major stimulus coming out of those countries. And of course, there are some inflationary pressures that come in from that oil price. The second very important factor is around shipping. The cost of shipping is really increased from Asia into the region, for example, around fivefold. All over the region across EMEA, we're also seeing increasing shipping costs. And we also have high growth in the US and Europe, attracting more supplies there as well. And we believe that costs have likely peaked, as you can see even in the slide here, but we don't expect a decline very, very quickly.
Now, there are also additional factors that are impacting costs, and those can be categorized into the foreign currency dynamics. And so if we start with Lebanon, really, with the government in place and the restart of the IMF talks, we should be expecting to see some concrete moves on devaluing the currency. The most likely initial level will be a range around maybe 8,000 liras to about 10,000 liras against $1. However, should we rather see perhaps a continuation of the politically driven violent tensions, then the central bank may be forced to devalue to even a lower level, which is around 12,000 liras to $1. And so we ought to factor in the challenge of limited access to foreign currency in Lebanon in 2022, as inflows remain to be quite weak. Now, on the very polar opposite, Egypt is seeing some strong inflows of foreign currency driven by bettering exports, tourism, and also oversubscription in the central bank issued bonds. All of those are supporting the currency at around 15.5 Egyptian pounds versus $1 for 2022. Now, as we see the US Fed raising interest rates in the future, there is a risk, yes, of investors turning away from emerging markets, but we do believe that the risk is currently very low for a country like Egypt.
And in Iraq, we expect the Iraqi dinar peg will hold in 2022, and the Iraqi dinar will likely remain stable at around 1,410 to the US dollar. And this is supported by the high oil prices that we are seeing. Now, we expect the significant increase in foreign reserves will ensure the stability of the dinar, especially as they significantly outweigh foreign currency obligations. As for Algeria, in our base case, we expect the Algerian dinar to depreciate by around 12% in 2022 to 152 dinar to the US dollar, as the central bank seeks to close the gap between the black market and the overvalued and pressured dinar. So access to foreign currency will likely remain challengingly limited due to reduced hard currency inflows.
So it's a mixed picture on the currencies front. We have some currencies that are actually benefiting from that relatively stable financial environment, but some actually experiencing domestic pressures on their exchange rates. And they are going to have different effects, of course, on domestic inflation. But overall, that high operational costs are definitely going to be trickling through gradually into consumer prices, and will continue to do so actually in the next probably 3 to 6 months. So we would expect to see higher inflation in the coming period. And there will be some factors that might keep headline inflation low, but cost of transportation, food, and utilities will increase and pressure consumer budgets. Iran and Lebanon, as you can see, are facing additional currency depreciation pressures, while Qatar is likely to implement the VAT next year. We're also seeing Kuwait and Iraq also experience higher subcomponents of inflation beyond what you see on the headline figures here. And if we just even give you an example of what that looks like, if we look at Saudi Arabia, you see headline inflation previously averaging on an annual level at around 3 to 3.5%. But if you look at the components, transportation, food, and utilities have been much higher. And with the VAT kind of base effect stabilizing, you might even see headline inflation much lower, around 0%, but that actually doesn't mean that the subcomponents are going to be putting some higher pressure on Saudi consumers. Plus, you see this kind of inflation here, but you have wholesale prices around 20 to 25% in Saudi. So you're actually seeing that those additional cost pressures on businesses are not even fully passed on to the consumers.
And really, the rising global costs, be on the energy side, be on the shipping side, or the commodities, those are all trickling down into Egypt, with businesses and producers finding it a lot more difficult not to pass the costs on to the end customer. And so given that Egypt is so heavily reliant on a high level of imports, we will see imported inflation adding to price pressures and averaging around 6.5% to 7%.
Hi, my name is Krista Regani, and I'm Marketing Director here at FrontierView. I'd like to thank you for watching a segment of this webinar. If you'd like access to the full video and our latest insights, data, and research, sign up for a free trial with us today. Simply scan the QR code on the screen.